Hey, good afternoon, everybody. This is Brad Lewis with Premier Marketing. I want to thank you for joining our call today. We're going to take about an hour of your time today to go over the 8 reasons everyone needs whole life insurance. And before I get started, I wanted to make sure I noted that this is the second webinar that we've done with Sean. The other one was last week. Very successful webinar, and that was how to double your income in 12 months. So if you didn't have a chance to see that one and you'd like to, make sure you reach out to your lifer or annuity marketer and they will get you that recording for that to make sure that you're caught up. This is part of a series of webinars that we're doing. So after this one, we have 2 additional webinars that we'll be doing for the life insurance portion of it. And the whole basis of this is to help you grow your business by offering products to your clients that you already have, and then being successful in learning the ways to offer your clients these products through the sales system and ease of doing business that Sean will introduce on the call today, as well as the other webinars that we'll be having also. So without further ado, I want to introduce Sean Ruggiero. Sean is a integrity partner. He's also the CSO at Brokers International, one of our partner offices that we work very, very closely with. And he's also a great friend, and I consider him a mentor of mine as well. So, Sean, turn it over to you.
All right. Yeah, and likewise, Brad, I always enjoy being able to talk to you, whether it's personally or professionally. And I'm happy to be on. And what Brad and I were speaking about before this started, and hopefully some of you are watching live. I know a lot of webinars I've signed up and I watch them recorded, right? Get home, get the PJs on. Well, I don't wear PJs, but you know what I'm saying. Get comfortable and then you digest that. Or my morning coffee. Let's put the AirPods in and listen to it. But I hope that you're watching. And the reason why is because this is not just a one-time cure. You learn a lot, but Brad, there's that statistic that people learn 90% of their job within the first 90 days, and then they never learn anything else. And when we talk about life insurance, when we talk about health insurance, we talk about all the things that it encompasses, protecting human capital, protecting financial capital, stuff that we discussed in last week's webinar. I don't want agents to sell themselves short. And with open enrollment coming up, we understand you're going to be busy. The webinar after this one they all tie in, but it is phenomenal. I just please watch it, do what I say, and you're going to have such great results and such happy clients. So we just want to kick it off of that and say, keep learning, keep pushing, don't settle. Right? If you're going to retire, Brad always says, if you're going to retire in the next 90 days or quit, just hang up now. Don't pay attention to it. But if you're going to make this your career, if you've been doing this for 3, 4, 5, 6 years, if you have 10 years left, 20 years left, then buckle down and learn this stuff and use the resources. Ask Brad, ask the marketing team, ask me, and we're going to make you better. All right. I've been doing this for 20 something years. And Brad, I'm one of the few people here, I joke about it, but as the chief sales officer, we had a sales meeting with 60 some odd people at brokers. And I asked them, how many of you have sold, like, paid your mortgage and fed your family and covered lawsuits? And I was the only one. But what I'm saying is I'm not bragging. I'm saying I know your story. I know your struggles. It's a very lonely, difficult road sometimes. It's hard work. But knowing that, I know how to approach it, and I know what the ups and downs are. And I know that having a knowledge and understanding of what to ask in a simple process that has been set up by Premier, backed by Brokers International, you really will double your income. So that being said, I'm going to go as quickly as possible. This is my longest presentation. It's not arduous, but it is my longest presentation, but it is arguably one of the most impactful ones, because I want you to understand why whole life insurance, which is inclusive of index universal life, which is a very popular product for good reason, is pertinent for people, especially those who are 65 and older. So I want you to learn the right reasons, because Brad, what we have right now is we have an epidemic. We have too many people who got an insurance license, and now they're out on TikTok selling IULs like it's the greatest thing since sliced bread. That is not what we're going to do. I'm going to show you very, very meaningful and legitimate ways that life insurance helps, permanent life insurance, and it's going to make sense. And so you're going to also be able to get a copy of this, because Brad, this is technically set up to where if you wanted to put your pictures, your label, your branding, you could present this to a client. It's got citations. I've run it through compliance, and you can make it applicable to that. So let's go ahead and get started. Brad, I see, is there a question or comments here? I saw something blinking. Nope, I think we're good.
Nope, that was
Okay.
me. Yeah, I just I forgot to mention at the beginning to go ahead and place any questions in the questions section, and we will get to those either during the presentation or at the end of the presentation.
Okay, excellent. All right. A little bit about me, and I will make this briefer and briefer. Like I won't even say it on the next webinar, but I'm a managing partner in Integrity Marketing Group. I do have a securities license. I had my own registered investment advisory firm. I'm the author of 7 Benefits of FIAs for Retirement and the Chief Sales Officer at Brokers International. Important notice, myself, Premier, Integrity Marketing Group, and all of its affiliates do not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, and accounting advice. You should always consult your own tax, legal, and accounting advisors before engaging in any transaction. And if you ever give this presentation to a client, I know this sounds kind of silly, but explain this to them. Legally, it's important, and you want to explain to them this is concept. Everybody's situation is a little different. I'm here to help you navigate that. But if you have a tax question, if you have an accounting question, I'm a licensed life insurance agent or health insurance agent. You need to be consulting those appropriate people before you make a final decision on any of these products. Okay, let's set the baseline. Let's give a foundation. Whole life insurance, and notice I put IULs, is a financial asset. Now I want to clarify something. I did this presentation a couple weeks ago, and I had a group of boo birds that said IULs are not the same as whole life insurance. Okay, that was my fault. I thought I clarified it, but maybe I didn't do a good enough job. So I'm going to explain this very, very, very clearly. There are 2 basic types of life insurance, right, Brad? There is term and there is whole life. Now, underneath that, there are variations. There's increase in term, there's decrease in term, there's annual renewable term, right? But term life insurance is something you rent. It does not build cash value. It is the lowest cost per $100,000 of coverage. And it is not designed to cover people into their 70s and 80s and 90s. It's just not how it works. Whole life insurance also has subsets or variations. A traditional pay to 100 whole life insurance is a level premium, and by age 100, you're done paying, right? So great, you lived 101, Brad, and you no longer have to make payments. And it's a level guaranteed death benefit. If you keep making these payments, then you'll have $100,000 of death benefit, and it builds cash value. Okay, that's a whole life insurance. There are variations of whole life insurance. There are universal life policies. There's variable universal life policies. You need a securities license to sell. There's index universal life, right? So IULs, when I talk about the benefits here, you'll see I interchange whole life and IUL because the benefits I'm talking about are congruent with both. If you believe like me, if you believe that the US stock market will go up more than it goes down, if you don't believe that the market's going to go down every month, every year for the rest of your life, then IULs, and I can defend this, this is a factual statement, IULs are a more intelligent form of whole life. Period. End of story. That's it. But it's like an index universal or a fixed index annuity, Brad, compared to a MIGA. Any given year, a MIGA could outperform a fixed index annuity because the market could go down. But statistically, over a course of 10 or 20 years, a fixed index annuity is going to outperform them, but they're both annuities. What I'm saying is that IULs are a subset form of whole life, and I interchange them because in most instances, we're using IULs, a properly structured IUL, versus just a level whole life. But that's not every time. Brad, I'm working on some estate planning stuff, and I'm actually looking at Lafayette, a participating whole life plan. So it doesn't matter. The values I'm speaking of are in both of them. Even if I say IUL in one, or if I say whole life in another, I understand they are different, but an IUL is a form of whole life. So hopefully I didn't bore anyone with that, but I had like 5 people who were being boo birds who wanted to just point out that I was wrong. Well, I'm not wrong, and I'm explaining it to you so you understand why I interchange IUL and whole life, but I'll move on. So whole life insurance, including IULs, can have guarantees. See, this is a financial asset, not an investment. Brad, if you buy a bunch of Tesla and Elon Musk, and this is not, I don't care, but he does something terrible. He goes murders someone, or is convicted of something real bad. I'm not going to say stuff, and the stock tanks. Do you have a guarantee that it won't go below a certain value? Absolutely not. See, investments have risk. A whole life insurance policy or an IUL, they have guarantees. They can have guarantees, such as guaranteed death benefits, guaranteed premiums, and guaranteed cash values. Whole life insurance, including IULs, passes to your loved ones tax-free and can provide access to cash tax-free. Now, notice something here, Brad. This is very important. I want everyone to understand this. I am not trying to defy math and physics and tell everyone that, hey, you know what you should do is start an IUL at 65, then by 75, you can live tax-free. You can't do that, not unless you're putting a boatload of money in. And there is quite a bit of drag created. Like if we had to equivalent to an expense ratio, it's like 6%, because an IUL is a life insurance policy first. They have to take out fees, they have to take out cost of insurance, and then the money left over in reserves is indexed. And there's some value to that. I love IULs, but please don't oversell them. Don't go start TikTok videos where you're saying, hey, cash out your 401k and buy an IUL, because you'll go to hell, right? We want to sell things the right way. It alleviates the pressure and the stress. It makes us enjoy our life more. And you don't need to be making this all about, get under the oppression of the man, avoid taxes, turn everything into tax-free. Because Brad, you know what? If someone came to me with $400,000 in an IRA and they were concerned about taxes, do you think I would have them cash it out and put it in IUL? No, I'd have them cash it out, put it into a Roth IRA, an annuity with like a Performance Pro 15% bonus, and they do a 15% tax recapture like that. And now no money is being spent to fees and cost of insurance, right? So enough about that. I'll leave it alone, but understand you're going to learn how to sell these for the right reason. And one of those reasons is the tax-free benefit. So even though this is not meant to be lifetime tax-free income, even if you started an IUL or whole life policy at 65, you're going to be building tax-free cash that you can access for emergencies, for whatever you want. And the death benefit is tax-free. That is a tremendous asset right there. And stocks don't do that. Okay, finally, whole life insurance can provide benefits that help offset healthcare and long-term care costs. Brad, one of the statistics, and we have a great presentation next week, which is really quick, so you're going to be alleviated of my long-winded talking this week. But one of the questions we have is, do you currently have a long-term care policy? Statistically, 70% of people who are 65 or older are going to need some form of long-term care, and less than 5% have it. So isn't it cool to know that you could provide a life insurance policy that can have living benefits and provide a solution in lieu of long-term care? And let me say this twice, life insurance is not long-term care insurance. Life insurance is not long-term care insurance, but it can be a powerful alternative. So these are the 3 things. This is my elevator pitch, right, Brad? Hey, Brad, you know what? You know why you should consider a whole life policy or an IUL? Because it's going to provide you guarantees that other investments don't. It gives you access to tax-free cash and pays your loved ones tax-free, okay? And it can provide benefits that will help offset your long-term care costs, right? Those are 3 powerful things that you need to know. That's how we want to approach it. Now, I'm going to talk to you about building a financial pyramid, not a pyramid scheme, but a proper financial pyramid. All right. This is actually in like the CFP exam and I think the CHFC exam. So if any of you have securities license or those designations, you might recall this. But they talk about the proper financial pyramid. Now, here's what the proper financial pyramid is. At the very bottom, We have protection. Well, what is protection? Protection, Brad, depends on your age. Remember that slide where when we're younger, we don't have a lot of financial capital, but we have a lot of human capital? If we have a lot of human capital, how do we protect it? We protect with life insurance. Because if I die, I lose my ability to do, learn, and earn. To do, learn, and earn. So I am protecting my most valuable asset, my human capital, with life insurance. Then you should have 6 months of savings. Some people have 3, some people have none, some people have a year's worth. Then growth. What's growth, Brad? Growth is our 401ks, our IRAs, right? It's the one that you're putting $500 a month in and you're leaving it alone and you're growing towards retirement. You're taking advantage of dollar cost averaging, you're putting stuff in the market and growing it over time. Now, what happens as this pyramid tapers? Then we get into risk. Maybe single stocks, right? Maybe cryptocurrency. And then at the very end, we have speculation, right? Technically gold's a speculative investment. Gold doesn't have any IP. Gold doesn't have a payroll. Gold doesn't own any patents. Gold doesn't have, you get my point, right? Gold is just what people will pay for it. So it's a speculative investment. See, we're living in something, and I encourage you all to understand this, learn this, and talk to clients about it. It doesn't matter if they're 20 or 70. Many of our people today, many of our clients are living what we call the Robinhood generation. Now, what do I mean by that? Do you know that app, Robinhood, the investment app? Well, I think it's great that we're encouraging people to invest, but we're getting people access to investing, oftentimes in single stocks, and not educating them on what a proper financial pyramid would be. I'm going to give you a real life story. Chris, I won't tell you Chris's last name, but Chris is a good friend of mine. He trains our kids. He's young 30s. He's a pretty successful trainer and coach, right? A personal trainer and coach. And he comes to me and he says, I got $3,000. Should I put it in GameStop? Y'all remember that, right? Meme stocks, GameStop and these ones that they're manipulating it. Should I put it in GameStop? And here's how I responded. I asked him, I said, Chris, you have 2 boys. How much life insurance do you have? 0. Okay. Chris, how much do you have in savings? $3,000. The money that I want to put in GameStop. Okay. Are you currently in a self-directed IRA or a Roth IRA, or are you participating in a 401k through your company? Nope. All right. So, Chris, you have an inverted pyramid. Every ounce of your net worth now, you're speculating, you're guessing. You're wanting to buy GameStop for why? That's an improper financial plan. We need to teach this to people. You don't need a securities license to show this slide to someone and say, hey, we believe in creating proper fundamentals for our clients. We believe that too many Americans today, and it's funny, Brad, because you start telling people about the Robinhood generation, because most people are older, think younger generations are idiots. It's always been that way, right? So you start talking about the Robinhood generation and we want to do things right, they get it. Because here's the deal. If we look at an index universal life or any whole life policy, the bottom 3 pieces of the pyramid are all covered. I'm not saying it's the only thing you need to do. I'm not saying you wouldn't have some savings account or another term policy or whatever it is, but isn't that a wonderful solution? So, hey, Chris, rather than putting that money in GameStop, which could decline and disappear by tomorrow, why don't we work on putting together a proper financial pyramid? Let's purchase an IUL. And that IUL is now going to provide protection. You're going to start building up tax-free savings, and you're going to build up growth, money that you could use to supplement your retirement later on. So that's what a proper financial pyramid is. Now let's go through the 8 reasons now, and I'll go rapidly. I'll pick up speed a little bit here. Ensuring your human capital. Who's going to take care of your family when you're gone? You need to protect your human capital with life insurance. Here's the statistics, okay? And the citation is right there, right? The insurance barometer study that happened with LIMRA. LIMRA discovered that the average American will earn, this is based on a $65,000 a year salary, Brad. The average American will earn over $3 million in their lifetime. But what happens if they die too early? A lot of people don't have enough insurance. They also reported that 50% of American adults have life insurance, but 27% of those are relying on their work insurance. Well, guess what? The work insurance is rarely portable. It's not going to be there when you need it. You don't own it. And it's rarely enough. So the bottom line is this: Americans are underinsured, and we need to solve that. Number two, we need to cover your final expenses. You see how I'm starting with the very basics, Brad? Now I've got a couple advanced concepts, and I'm going to tell you right now, I don't hide anything from agents. I've worked with people who feel that agents are stupid. You just keep them on task. Well, don't tell a Medicare agent this. They're going to start getting distracted and think that they can go sell it. Give them everything, right? And that's the thing I love about Brad and the people at Premier is they're saying, Sean, teach them everything. For those people who it resonates, who it makes sense, they will pursue it. For those that don't, no problem. But in the back of your mind, you're going to run into people, we're into clients over the next 30 days or 3 years, who you're going to think, you know what? I remember something about this, and this is why you should be looking at a life insurance policy, a permanent life insurance policy. But let's start with that basic. Number two, covering your final expenses. So a funeral alone can cost nearly $10,000. And Social Security, Brad, I think it's like 298 bucks they give you. It's less than 300 bucks. So who's going to pick up the difference? Is it fair? I mean, it's probably fair. I've given my kids a lot of money, right? Maybe they owe me. But point being, I don't want that to be how I'm remembered. So at a minimum, wouldn't I want to cover my final expenses? How many clients do you sit down with? And Brad, I'm thinking now, not even an IUL. Like Mutual of Omaha IUL Express is a great product, but maybe we're just talking about a $5,000 or $10,000 core bridge policy, just a guaranteed level whole life policy, something to cover their funeral expenses. Well, when you have that client who says, oh, we got it taken care of, statistically, they're lying 73% of the time. Why? Because according to debt.org, 73% of Americans die with debt, 73%. How can you change that trend? You can help them by selling life insurance, IULs, traditional whole life, level whole life, final expense. I never call it final expense to an actual client, can now be sold to help cover that. And that's not going to follow them, beyond the grave. All right, number three, Brad, probably the most powerful one. Make sure when you're, and then we're going to cover this next week, make sure when you're speaking with your clientele during open enrollment, you're asking them this rhetorical question. Do you currently have a long-term care insurance policy? I say rhetorical because statistically less than 5% do. Does that mean that they're not going to need long-term care? No, because statistically, 70% of the people who are 65 and older will need long-term care, some form of it. Yet less than 5%, as I explained earlier, even own a long-term care policy. So you now have the ability, and we're going to teach this again on the next week's webinar. We talked about it last week. If they have something that acts like life insurance, like an annuity, like an IRA, then they can use that money to help pay for long-term care. They can even purchase a Global Atlantic 4Care policy. There's lots of things they can do. But if they don't, which many people don't, what do? Are they just screwed? Brad, getting approved for a long-term care policy is not easy right now. And when you're on a fixed budget, it's also not very affordable. Well, they might be able to purchase life insurance with living benefits that, although it is not long-term care, I said that 3 times now, life insurance is not long-term care. It offers some great benefits to offset the end of life cost, the end of life care cost. But what if, Brad, what if we're talking to Brad Lewis, who's done well for himself, and he feels like he's self-insured, right? Oh, I don't need that. I'm self-insured. This is a true story I'm sharing with you. I won't tell you the person's name. He lived in Seattle. And I had a financial inventory of all his assets. And he was concerned that he would have to pay an estate tax, okay, a death tax. We're going to get into that a little bit here, when he died. He also was concerned that if he needed long-term care, which he remembered taking care of his mom and his dad, that he would need money set aside to take care of the long-term care cost. I mean, he was wanting like a nurse that lived in the home or stopped by 4 times a week, and medical equipment, and like the type of thing where you turn your house into a hospital. And I said, okay, you're self-insured. Let's call him Tom. You're self-insured, Tom. Let me go through these assets. Tom, what are you going to liquidate when you need to pay for long-term care or in-home care for end of life care. What are you going to liquidate? Are you going to liquidate your Amazon stock? Now he was very proud of this. Amazon, since it IPO'd late 80s, early 90s, he had owned it since like 96 or something like that. It split 4 times. It's grown 6,871%. So are you going to liquidate your Amazon stock? He said, hell no. He goes, you're a financial advisor. You know I would never do that because then I lose the step up in basis. I want this to go to my kids. Yeah, okay, I get it. Makes sense. How about that Stingray Corvette? No, no, no. I could never sell that Stingray Corvette. My daughter loves that thing. Not selling it. He had a paid off condo. I think it was South Carolina. How about the condo? Nah, my wife, and his wife was younger, healthier. My wife, she loves it there. She might downsize and go live there. I can't, it's paid off. I can't get rid of that. All right. Are you going to sell the boat? Right. He had this very nice boat that he always bragged about. No, I can't do that. The boys love it. And the grandchildren love it. Like I can't take that away from you. All right. Tom, what about the house? I mean, if your wife's going to live in the condo, then we can sell the house. No, I said she might live in the condo, but she might live in the house. And then I'm not making this up. The final thing was emergency cash. He did a very good job. He had assets; they were paid off. He made good money. He had IRA, but he had $100,000 of emergency cash. I said, "Well, would you use the emergency cash?" He said, "No, Sean." And I said, "Why?" He said, "Because then I would have no more emergency cash." See, these are all things that we have an emotional attachment to. If you really thought about it in your own life, it's hard to separate with assets. It's hard, right? You know what we're not emotionally attached to? Life insurance. So Brad, you and I are getting up there in years. I was a Star Wars fan, but you remember Star Trek and how they would be taking these lasers and these torpedoes and Bones or McCoy or whatever would put up the shields, and he would tell you that the shields are at 20% or 15%. Do you remember that Star Trek stuff, Brad?
Absolutely. Yep.
Yeah. Yeah. See, think of life insurance as your shields. Do you know what you have no emotional attachment to? Life insurance. So if worst case, you die happily in your sleep and you don't need any long-term care, great. You just passed on everything tax-free. You just passed on tax-free life insurance policy that is a benefit to your loved ones. But if you are one of the 70 percenters, you don't have to liquidate any of those things. You put up the shields, take the torpedoes, and life insurance using its living benefits can now provide a shield and provide money as a pseudo long-term care, as an alternative to a long-term care policy. All right. Number 4, protect your estate and cover your taxes. You've worked a lifetime to create wealth. Do you really want to give it away to taxes? Now, here's where I tell people, I believe in agents. If you think this is complicated, confusing, okay, I don't. And I think that for everybody who's going to watch this, if they, maybe half of them are not following, but the other half, this makes perfect sense. So Brad, there are 19 states that when you die, you owe death tax at the state level. Everyone else is federal. So I'm just going to look at federal. So what it means is, Brad, when you die and you got all that money, Brad, and it passes your exemption, passes over to your spouse, and then when she finally dies, then the federal government comes knocking and says, you owe us tax. A lot of people don't even realize that. You get what's called an exemption. You get an exemption. They say, well, we only want tax if you're over a certain amount. I want you to look at the history of this and then contrast and compare to where we're at today. Back in 1997, and by the way, this counts your life insurance, this counts your net worth, this counts your homes, your assets, your stock, your cash, this counts everything. So Brad, 97 wasn't that long ago. Like I was in college, you know what I mean? The exemption was $600,000. That's it. Anything over $600,000, you're now subject to a top estate tax rate of 55%. Wow. And then it moved to 625, 650. Let's go to 2001. Brad, I lived in San Francisco in that time. There were people who were just darn near silly dumb, and they were selling companies and getting these investors and making millions. If they died, crashed their new Ferrari that they got, Can you believe that their exemption was only $1 million, yet they just cashed out 16 million of stock or 60 million stock? The federal government or the state steps in and takes a big chunk. It wasn't until the Secure Act in 2018, you see how high that bumped? It went from 5.4 to 11 million. It's up to 14 million now. And that passes on to your spouse. I'm going to ask you a question, Brad. I'm going to, like honestly, and I haven't prepped Brad for this at all. Knowing that national debt, just the payment, is now our third largest expenditure, knowing that it is now past military spending, knowing that only Social Security and Medicare are more expensive to the federal government, do you think that the exemption is going to stay that high for the rest of our lives?
No, there's no way it will.
There's no way it will. I mean, it's just freaking impossible. And by the way, if it does, no big deal. Meaning, hooray, we can all be excited that we didn't have to pay state tax, but no way it does. That's why I'm educating about this. If you took the time to listen to this recording, you can explain this to clients. And you know how many times that client has had this explained to themselves? Zero. Now, are they worried about having $20 million in their life when they are 30 million? No, I'm talking about when we get back to normal, you're going to have plenty of people who die with a $2, $3, $4, $5 million estate. Plenty, right? Let's educate them. I'm going to show you the intelligence of life insurance planning. See, let's say we had a $5.9 million estate, and it was made up of stocks and bonds and collectibles and houses, right? If that exemption came down and they died, they might owe some federal income tax, or they might be in a state like New Jersey. Brad, wild guess, right? Do you know what the minimum amount is for them to tax you at New Jersey for a death tax? Net worth?
I don't know. I'm not sure what that is.
950,000. What? That's,
Really
I mean,
low.
it's only like a 4%, but are you kidding me? Like that's super low. That's terrible. So there's 19 states that have lower exemptions already. So regardless of the federal government, regardless of it, and I'm not trying to get too complicated. If you're getting this at all, then if you care, if you want to make a lot of money helping people out and selling some good life insurance policies, then you're going to embrace this and figure it out. But here's the bottom line. Here's my estate at 5.9 million. If I took $200,000 of it, put it into a single pay or a 10 pay IUL in a separate ILIT or irrevocable life insurance trust, only attorneys can set up trusts. Okay. You can't, it's not a will, it's a trust. It has to be done by an attorney. But could you imagine partnering with an attorney? You can get them online. There is Brad, type this avvo.com, AVVO.com. Type that in the comments if you don't mind. It's a great resource where I found good attorneys that you could use and partner with and say, hey, I have a client that's interested in setting up an irrevocable life insurance trust. Can we talk? Next thing you know, they're sending you clients. I've had that happen a number of times, right? But now look what I did. I took $200,000 to create a $1 million, so pennies on the dollar, tax-free death benefit benefiting my loved ones or whoever I want my beneficiaries to be. And I put it in an irrevocable trust, so it's a separate entity. It gets its own taxation. So now, what have I done? I have put my loved ones in a position where they don't have to liquidate because the $1 million comes over and you can pay any estate or death tax out of the life insurance policy. And what if we're both wrong, Brad? What if it defies math and physics and the exemption for the next 40 years stays the same and it's way higher? Okay. Well, tell me this. What's a higher number? 5.9 million or 6.7 million? Because you just created a $6.7 million inheritance with 1 million of it being tax-free. So let's say we're all wrong. We don't have to worry about it. You still put your family in a better position. That's the intelligence of life insurance planning. Number 5, leaving a legacy. What do you want written on your tombstone? How do you want to be remembered? See, a final gift of generosity can leave a lasting legacy. I've known some bad people, and at the end of life, maybe they could do some good. A lot of times we do that through charitable giving. So let's challenge this right now. Could you imagine if you asked, and we have it on some of the financial inventories, are you making any charitable gifts monthly? Are you making any charitable gifts monthly or annually? Not surprisingly, a lot of people are going to say yes. Well, let me ask you this. Mr. and Mrs. Smith, what makes more of an impact? $200 a month or a $100,000 tax-free lump sum? Which, right? Now, there is some innuendo about write-offs. You could write $200 off a month. It's a little bit more complicated when you make a charity the designated, or when you make the inheritor the charity. Right? It doesn't quite work the same way. Point being, don't worry about that because you can still take a great deal of advantage out of this by changing how you approach charitable giving. Let me explain that to you. See, charitable giving doesn't have to be a huge sacrifice. It doesn't have to be a bad investment. I'm going to ask you something. So, Brad, let's say I'm sitting with you, and let's say you turn 61. And I say, Brad, are you making any investments? And let's say your charitable giving is to ABC Charity. It's just a made-up charity, ABC Charity, right? I say, Brad, how much are you giving to them each month? And you say $200. Brad, can I propose to you an option? What about rather than giving $200 a month to that charity, you put it in a life insurance policy with the beneficiary being the charity? Here's where I'm at. Brad, if you died next year and you wrote a check for $200 every month, how much money would you have given them that year? $2,400. But if you died, not saying you will, you gave them $84,000. That's an internal rate of return of 3,402%. Now, we don't want you to die, but why not? Now, let's go with a more realistic projection, right? Brad, let's say you died at 80. And for the record, Brad, you're going to live to 120. But my hypothetical, Brad, let's say you died at 80. If you were putting $200 every single month, then when you died at 80, Brad, how much money are you going to be giving them? You're going to be giving them $48,000. $48,000. But if you put that same $200 a month into an annuity with them as the beneficiary, you gave them $84,000. Real quick math question, Brad, which is higher, 84,000 or 48, right? And you can write off a certain amount. There's actually a calculation on charitable gifting of life insurance policies. And here's one last thing. So, I mean, as a lever, as a pennies on the dollar argument, it makes sense. But I'm gonna present to you one last thing, Brad, why you really need to consider shifting that $200 a month from just writing a check and putting it in an insurance policy. It's called recourse. Recourse. I'll give you two examples. Now, Brad, I am going to name a charity. It's just said with no neutral, positive, or negative impact. But the National Rifle Association, lots of people. I live in North Idaho, right? Like, you would not want to rob a bank there. You're probably going to have 80% of the people with a firearm on them. You don't want to start honking at people in North Idaho or Montana, where I live. Okay. And so my point being, a lot of them donate to the NRA. Okay. You've seen on the news, the NRA, the chairman got in trouble because he was using funds to fly his family around a private jet and really questionable things. So I'm going to ask you something, Brad, please answer, right, as rhetorical as it is. Brad, if you got upset with the charity, remember that ABC charity or XYZ charity that you've been given $200 a month for? If you found out that there was corruption, that they endorsed Jared from Subway, or I'm not trying to be overly harsh or nasty, money does funny things to people. People get corrupt. If something happened, can you call them up, Brad, and say, hey, I gave you $48,000. I no longer believe in what you're doing. Can I have my money back?
Nope, you can't do that.
Can't do that.
No way.
Another thing, what if your financial situation changed? What if your spouse died earlier than expected? What if you had a child or a grandchild that wanted to go to college that you thought was going to be a scholarship and didn't? What if it was one of the million things that can happen over the next 2 or 3 decades? Can you call up the charity and say, hey, I actually need that money back because I need to give it to my grandchild? No. See, this is called recourse. You now can change the beneficiary to your kids. You can now access the cash value. So bottom line, you're going to end up, let's say everything works out great. You die at age 80, you put in $48,000, you get the charity $84,000. That's pennies on the dollar. It's a lever. It's a smarter way to do it. But you also have that recourse. So I hate to exacerbate this, but you're going to have a lot of people ask that question. Put it on your financial inventory. Are you making any charitable donations? They're going to answer you every time. And then every time you can go back and say, can I give you an alternative? And here's the reasons why, right? Okay. Number 6, elimination of sequence returns risk. Understand sequence of returns risk. We always have heard this before. Sequence of returns. In what order do you get the returns? I need to point something out first. If you are not taking money out, then sequence of returns does not matter. Let me explain. In Bob's portfolio, the one on the left, he had high gains his first 3 years, but his last 3 years, he had a lot of losses. But at the end of 20 years, because he was not taking money out, he has 1.1 million and he gained 121%. But what about Ted? See, Ted finished strong, but look at the losses the first 3 years, -10, -13, -23. You'd think, oh, well, that sequence of returns risk, right? He's screwed. No, only when you take money out. If not, then it's your rate of return. Rate of return is all that matters because look, Ted has the same exact amount of money. He has 1.1 million at 121% return. Doesn't matter if you're not taking money out. But contrast that with this. Once you start taking money out, and so let's say we have Bob and let's say we have Ted, and now they start taking out $25,000 or 5% every year. Now the rate of return doesn't matter. It's the sequence of returns. Let me explain. If we look at Bob's first 3 years, he got 44%. And overall, he got 121%. That never changes. But he's taking out $25,000 a year or 5%. Because his first 3 years, right, his trajectory was high, he didn't lose a ton, he made money. He actually retired, or he actually dies at 20 years later with more money than he put in. That's the power of the market. That's the allure of the US stock market. That's capitalism, right? Love it. But what about Ted? See, Ted had the same 121% return. We just showed it to you. But now Ted's taking out 5% a year. And even though he had a positive return overall, Ted's first 3 years was -40%. So now by year 18, so let's say he's now 78, right? He's out of money. He's out of money. That is sequence of returns risk. That's what you have to understand and prepare your clients for, because too many financial advisors are not doing that. And you don't need to be a financial advisor to point this out. See, you can use an IUL just like you can use an annuity to eliminate that risk. Track this with me. This is a very powerful slide. I teach something. This isn't unique to me. It's a method, okay? But I teach it because I believe in it, called a 2-bucket approach. See, the vast majority of retirees, Brad, what do? They got a 401k, they turn it into an IRA, they get a Social Security or pension, they just start taking money off the top. That's what they do. See, I've always said if you say smart stuff, people will think you're smart. Try this on. Write this down. I recommend that we look at a 2-bucket non-correlated approach for your retirement. Brad, I recommend that we take a look at a 2-bucket non-correlated approach for your retirement. Okay. What does that mean, Sean? Well, let me show you. In the left column, we have a $600,000 IRA. In the right column, we have a $500,000 IRA. Where did the other $100,000 go? It went into an IUL, okay, and created a second bucket. Now I understand there's some tax consequences, things like that. Just bear with me here. I'm trying to give you the rough overview. Now, what do we end up doing? We have to take out $50,000 a year because we're done making money. We're now living off that money. Remember, if we're not taking money out, sequence of returns doesn't matter. If we are taking money out, sequence of returns matters and rate of return doesn't matter. And what about rate of return? Okay. Notice that overall, both of these portfolios from 63 to 85 average 7%. And there are fewer negative years than positive. And none of the negative years are even as high as a positive year. So this is actually fairly favorable, arguably speaking. It's hypothetical, but arguably speaking. So in portfolio one, the single bucket approach, we are now running out of money by 81. We have taken out, now, see how it says 1.15 million, Brad? That's actually not true because that's counting the last $200,000. Well, we either had to rob someone or borrow it or put it on a credit card because technically we ran out of money by 81. But I'm just trying to prove a point here. Let's look at number two. Let's look at this, the two bucket approach. Now I only put 500,000 in and I only took out 800, but at the end of it, I still have nearly $200,000 in my IRA. Why? It's very easy. See, every time the market was negative, let's say you're looking at the end of the year, you're like, damn, my IRA, my fixed index annuity, well, they don't go down. So my IRA went down 10%, 20%, 6%, 3%. I am not going to take money out because I set myself up well with a two bucket non-correlated approach. So in those years, I'm not going to molest the IRA because you never want to sell high and buy or buy low and sell high, right? You want to, I'm sorry, you never want to buy high and sell low. And that's essentially what you're doing. Now, I know what some of you are saying. Yeah, but Sean, where's the other, $350,000? Well, let's look at the second bucket. This is an F&G path setter. Brad, I don't know if we've had them on yet, but they're a phenomenal company, and I love this product. No blood, no urine, quick issue, right? Very powerful IUL. So if we haven't got them on the docket, let's get F&G to come in and present. Let's get Tom Ross to come in and present this powerful IUL solution. F&G Path Setter, National Life, and Mutual of Omaha. I'm a huge fan of those three. But what do we have here? See, at age 85, we put in $100,000 and we took out $350. So remember, I still had to compensate for the other $350. So now we're at 1.15 million, even though technically that money didn't exist in the left one. So if anything, this is even more favorable to the two bucket. But just for what they say, shits and giggles, let's look at it this way. You put in 100, you reallocated $100,000, you put it in a second bucket, you got paid because that's a nice commission on $100,000. You took out the 350, and based on average returns at 6.54%, you have $1 million. That's not a typo. You have $1 million of cash left over. Brad, which is higher, zero or negative, or 195,000 plus $1 million, right? It's the latter of the two. Now, I know what you're saying. Well, what if it doesn't perform at that? Okay, what if we did midpoint assumptions? You still have nearly $200,000 of death benefit. Whoops. Nearly $200,000 of death benefit. Reality is it's going to be probably somewhere in between. You see my point. This two bucket approach, by reallocating a small portion of your retirement into a second bucket that's non-correlated, you could show this to a client. They'd be like, how do I get approved for this? Okay. And you can also accomplish it through annuities, just FYI. All right. Here is number 7, protection from creditors. Be very careful with this one. Brad, there is a website. I see it sourced right there, and I source it right here. Phenomenal website. If you're presenting to someone, you say, you never know. You might get sued. You might have your dog bite a kid. You might get in a car wreck. You might have someone, on a trampoline or a swimming pool. You have no idea. You might have a failed business. You might be liable for toxic contamination. I mean, who knows what it is? Are your assets exempt? Are they exempt from creditors and from bankruptcy, right? This website is fantastic because you hover over, and this law firm has put this together, and you have cited right here. So you say, well, based on this law firm's research, here's what it is in your state. Now, if you're in a state, if you're in Nebraska and you're only run Nebraska and it doesn't have an exemption, then just remove this benefit. But my point is, most of them, they do provide a benefit. Idaho, where my primary residence is, does have an unlimited cash benefit. Here's the exemption. You can't have the policy within the last 6 months, meaning you can't go get in trouble or predict that you're going to get sued or file bankruptcy and just put all your money in a life insurance policy. You have to have done it 6 months prior. That's not bad. And is it the same for creditors and BK? Yes. And is there any limit in the amount? No, there's not even a limit. So you could stuff $2 million over into a life insurance policy. And as long as it wasn't done within 6 months prior to a bankruptcy or a creditor judgment, they can't touch that money in the state of Idaho. Now be careful with this one. Research it. Make sure it applies to your state. But Brad, that's pretty powerful stuff, right? Not for everyone, but there's some self-employed people. There's people who just don't know. And these things build on each other. They build on each other. We talk about the intelligence of life insurance plan. We talk about a two-bucket approach. And oh, by the way, that same money could be protected from creditors. Here's the last benefit, and then I'm going to wrap it up. The last benefit is tax optimization. Okay, very similar to the two-bucket approach, but let's just simplify it. I chose the state of Washington because there is no state income tax. It's one of 9 states that is no state income tax. So this is like worst case. Let's say you lived in Washington. I mean, it doesn't matter. This applies to every state. So Mr. Smith, let me show you something. Let me show you another intelligent execution of life insurance. You currently have an IRA. If you take out $200,000, all of that money is going to be taxed. That's how it works. It's all taxed. So based on my calculations, and you see I have the citation right here. They can go check it themselves. It's calculating everything, right? It's a vetted website. So based on the tax calculations at smartasset.com, if you were in Washington, married, filing jointly, you're going to pay $41,353 of tax. But what if we reallocated just some of that, just 10%? Now you take $180,000 from your IRA, but you take $20,000 from your IUL. Same income, right, Brad? $200,000, but how much tax do I pay now? $36,663. See, a 10% of reallocation to a tax-free income source now results in an 11% reduction of taxes paid. So you tell me, Brad, you wanted the exact same income, but put $46.90 more in your pocket? Sign me up, right? And these are the things that if you go to these websites and start to search in your state, put together a rock solid presentation, you can really, really make some people's heads turn because they didn't know about this stuff. Everybody's selling IULs like hotcakes for the wrong reasons and with deception. Like I said, they're going to go to hell. There's plenty of benefits within IULs and whole life policies that sell themselves. You just need to be knowledgeable enough to present them. And I'm going to finish with this, Brad. This is the bigger picture. What you do matters. All right. You know, we have a lot of there's a lot of grassroots efforts and worthwhile endeavors to try to create more equality in this country. Well, equality is going to come down to 2 things, Brad. This isn't a political statement. This is fact. All right. It's going to come down to money and education. Money and education. What are one of the greatest things that you can do to build your wealth? Home ownership. That is a generational thing. A generational wealth transfer is home ownership. Well, let's look at white Americans hovering constantly above 70%. But then we look at other different racial groups, ethnic groups, like Asian or Native Hawaiian Pacific Islanders, right? Now they're hovering below 60%. How about Hispanics? How about Black Americans, right? We're hovering above 40%. Have you ever considered that when you were, and you're going to sit down with all types, right, Brad? You're going to sit down with people who are doing Med Advantage plans in the inner city. You're going to be sitting down with people doing Med Sup plans out in the country. Do they own their home? That's on the financial inventory. Do you own your home, right? Yes or no? Well, wouldn't it be wonderful? Did your parents, when you died, did they pass on a paid off home for you and the grandkids? No, right? You got to know who you're dealing with. Like my kids, Brad, your kids, they're going to be spoiled. I get it, right? But I wasn't. I grew up without a father. I still have to pay for my mom. We rented my whole freaking life. Wouldn't that have been amazing? Now she's not dead yet, and I pay for her life insurance policy. But isn't that an amazing gift that you could give? And a lot of people are inspired and motivated to do that. You can make a difference. People post on Facebook, they go to marches, they put signs in their yards. That's all well and good. You can make a difference as a life insurance agent. And I take that stuff seriously, right? You can talk to people about how to plan for the future and how to benefit the generations after them. How about women and widows in poverty? This is not a sexist statement. This is fact. Okay. Women are smarter and tougher. That's also fact, but they live longer statistically. And Brad, when we sit down, like I know this is changing for a good thing. You sit down in my house now with my wife and me, she's gonna have just as many questions. Like she has a voice. But there is a large grouping, a large percentage of people who are this older generation that were making financial decisions, and the man is making the decisions. Well, guess what? You're the one that's in the worst health. You're the one that's 2 years older. You're the one that's going to die. They don't tell you. I mean, they're happy to say, yes, Susan, you get to keep the higher of the two Social Security payments. But what they don't tell you, what they don't prepare you for, is you're going to lose your Social Security. So let's say her husband's Social Security is 2,000, but let's say Susan's is 1,000. When her husband dies, does that mean that the mortgage gets cut in half? Like, oh, your husband died, we're going to cut the mortgage in half. Does that mean a gallon of gas costs half as much? Does that mean a gallon of milk costs half as much? No. See, this is a statistic, a factual statistic in the Center of Retirement Research in Boston. 1 of 6 women fall below the poverty line after the death of their husband. You can make a difference. If you just wrote a $10,000 policy, that might be 3 or 4 years of income replacement. Mutual of Omaha goes down to $25,000, very affordable IULs with guarantees all the way up to age 80 or 20 years, right? Whichever comes first. Phenomenal product. You could give her a decade of tax-free income replacement. What you do matters. I said money and education, money and education. According to the U.S. Department of Education and the National Center for Education Statistics, students from higher socioeconomic statuses, 60% of them are going to achieve a college degree. Now you can have all of the equal rights laws that you want, but at the end of the day, if you don't have the money and the ambition and the desire to go to college, you're not going to go to college. That's why we look at 14% from lower socioeconomic statuses end up getting a college degree. You can change that. Could you imagine writing a life insurance policy with a will or a directive or even a trust that says, I want this to go to my grandchildren and I want them to go to college? How powerful would that be? That's making a difference. And you can do it because you have a life insurance license, right? Brad, I know this took a long time. It's my longest one. I promise it won't take that long next time. We're right at 1:59 Central Standard Time. Are there any questions, or we can hold them to next week as we get back on time schedule? It's up to you.
Hey, thanks, Sean. No, that was awesome presentation. I really appreciate it. I know it's the longer one, but it's the one that gives you or gives me a lot of inspiration, especially the last part that you do there. It makes me really feel proud of what I do and how we help agents, and
Amen.
also as an agent myself, how I can help others. So very, very important to have that inspiration and passion behind what you do there. So just a couple questions really is, we do, I'll just answer them real quick here, but Michelle was wondering if we'll have a replay of this webinar. We certainly will. So we'll get that pulled down, cleaned up a little bit, and then that will be available probably sometime tomorrow. So if you just reach out to your marketer, they can provide the replay of this webinar for you. And then also a copy of the presentation. And you mentioned earlier during the call today or during the webinar that this is something that agents can use as well. So we will have the presentation available for you. So those are the only 2 questions right now. So I think we can wrap it up. And I'll start first. I just want to thank everybody for attending. I know it took a lot of time out of your day today, but I think it's well worth it. Again, like I mentioned, this is webinar number 2. We'll be moving into webinar number 3 next week, and that is how to use the financial inventory to create sales. So I assume you're going to get into the nuts and bolts of how to use that financial inventory and how to show agents how to get sales from that particular thing. So
you got it. Yeah, really good one, and it's much shorter, but you're going to find it's very, very powerful. When we start tying this all together, Brad, and just a little bit of determination, some humility, the ability to go out and be vulnerable and fail, to ask questions. But Brad, what Premier has set up with your marketers, with the Ask a Specialist, with some of the educational pieces that we have, by attending these webinars, by practicing, right? You'd be astonished. And sometimes you just need to be motivated. Like you're darn right. I just need to work a little harder. And now I'm going to, it's trajectory. Now I'm going to make this much extra income over the next 5 years. And then you retire and you got $3 million more of net worth than if you just kept doing the same thing. So I know it sounds dramatic. I know I get a bit worked up about it, man, but it's what I do, man. And I appreciate everybody being on. If you ever have any questions, Brad, you know, you can call me day and night, anytime. But if anyone has any questions, relay them through Brad and I'll get back to you.
Perfect, Sean. Thank you very much for joining us today, taking time out of your day as well to be our host, and appreciate you being with us. Thanks, everybody. Have a great day.
Take care. Bye-bye.